Nair and Rohit Srivastava from Indiacharts to decode how the markets are poised ahead of the budget. And of course, later in the day, we will analyze the budget threadbare with a whole bunch of market experts. Welcome to Moneycontrol. The first thing is, I want to set the stage for the conversation today. The fact that we are entering this budget with very modest expectations. In fact, I should say we are actually entering the budget with a great deal of caution. And there are three defining things that have played out in the past 1 month when the Nifty has actually shed about 2.5 to 3%. The first part is that there is a huge India sell, China, buy China and cheaper markets across the world, especially emerging markets, that has been playing out. And that has been a reversal of sorts from last year when India was, despite meaningful outflows, we were still doing very well compared to rest of the emerging markets, barring 1 or 2 markets like Brazil and Indonesia. The second part is that in the past few days, especially the last 1 week, there was this big factor, the Adani effect, which was playing out in the market, which was a dampener of sorts for market sentiment. And the third part is that today, the financial event itself, we have not had too much in terms of expectations, but the expectations themselves are muted, and therefore the market is perhaps not factored in very much in this budget. Net-net, the first part perhaps is going to play out. We will talk to other people, Rohit and Devina Mehra, who will shortly join us to talk about that part. The second part has already got resolved because the Adani FPO went ahead yesterday. And the third part, which is the budget itself, we will know in a couple of hours whether the finance minister has something to surprise the market, or are we going to maintain status quo? Santosh, your take.
Well, clearly, typically what you see in the run-up to the budget is always upswing in prices, expectations, tax cuts and stuff like that. But this time, as you mentioned, the three key reasons all have led to traders taking a very, very cautious view. So I think that could cut both ways in the sense that if there are any kind of positive reactions or positive announcements in the budget, you could see a big up move simply because players are not holding any positions. But on the other hand, if, for instance, the budget doesn't deliver, you already have the sentiment which is very negative, and the cautious mood, it could further hurtle downhill.
Fair enough. Rohit, your take. How are we poised technically? The derivative setup, the charts, what are they telling you today?
So it's a very interesting setup, I think, ahead of this budget, because if we just study history, we have seen that markets tend to find key reversal points right around this event, especially when you've had a prolonged upward trend prior to the event, or you've had a prolonged decline, or else a consolidation where there's been little or no action. So when you've seen any of these phases, the post-budget scenario has always been the opposite of what it was prior to the event itself. So if you've had a substantial rally in the last 2 months into the budget, you've seen a top. If you see a decline, as is the case right now, we've often seen a bottom. Even if there's a consolidation or dullness in the market eventually realizes where there's nothing negative in the budget and then often rallies out of it. So the 1 month that follows the budget is very interesting in the sense that it relates very much with what has happened before. Now that's one part of it. Now how did we get here? We've had 2 months of decline. And in this 2-month period, you have a couple of extremes being reached. One is, of course, we've retraced 61% of or 66% of the entire rise that we saw from the October bottom, that is at around 16,747. Second, we've got one of the highest volume of puts to calls ratio since 2009, which means the pessimism on the street, which was already there at the start of the year, but got even more thanks to the most recent events around the Adani group, is sort of giving us an extreme negative sentiment point to start with, which also is a sign to take a contrarian stance on the market. And the third one, which has happened in just the last 3 days, which may have gone noticed or unnoticed by the street, is the FIs, which were sort of close to not having much of a short position a week ago, are now close to 94,000 contracts short at the end of yesterday. So that's we've seen that whenever they've had close to 100,000 contracts short, the last 3 to 4 occasions we ended up with a short covering rally. So the setup to me is very much one where you would expect a post-budget rally, unless there's something very, very negative. To keep that from happening, I think we are set up for a good move ahead.
Well, Rohit, you mentioned that the put to call ratio is at an all-time high. So what does this, if you look at it the other way, it means that the smart money clearly is already anyway betting on the market not going down further. That's what one would make out from that, right?
Not really, because there are two parts to the put call ratio. One is the open interest and one is the volume. The open interest is actual positions. So the open interest put call ratio is down, which means that there are more calls outstanding than puts in the market. But when you look at the volume, you're talking about trader sentiment. And if a lot of traders are trading in puts, it shows that there's a lot of pessimism on the street. So a similar number, there was a 3 or 4 year high in the US PCR as well at the end of December as the Indian PCR was rising. That has resulted in the US markets rallying from there. It's just not happened in India for the reasons that you mentioned earlier, that there's been some fund shifting away from China, towards China from India. That's been one of the pressure points, I think, for this month. So our markets actually not behaved like the rest of Asia or Europe. But I think that's probably coming close to an end, because most of the selling from active managers will end. And then it's only the passive money that, then continues to drive flows. So that's what we are waiting for. And I think this FII positioning sort of also indicates that sentiment, reaching an extreme.
Sure. We can probably get Devina Mehra, her thoughts. Today is not only a big day because of the budget, there is also another very important event, which is the FOMC, the outcome of the FOMC meeting, which has been actually a defining factor in how the markets have behaved over the last 1 year. This year too, I think the entire pain of, of inflation is really not behind us. The markets are factoring in something, and every time in the past, the markets have gone in with a little bit of strength. It has been disappointed because Jerome Powell has made it a point to talk down markets in every single FOMC meeting. So yesterday, S&P was up 1.5%. We have to really wait and watch what is the outcome, which is not going to be very surprising. Everybody is expecting, majority of market participants are expecting a 25 basis point hike. Perhaps what is more important is again the tone of what the Fed chair talks about, and we'll have to wait to see that. And obviously markets have a mind of their own, and they will figure out whether it is moving towards dovishness or hawkishness, and we'll have to wait for that event also to play out to see beyond today how the budget proposals impact the markets. Santosh.
Well, very clearly, I think the one overhang on the market at this point still is the short-term, long-term capital gains and the tweak to that structure, because that is something that the market has been watching with bated breath. So in case of any negative surprise there, I think that really could lead to some kind of a big bearishness change in sentiment, because other than that, clearly, as even Rohit mentioned here, overall the factors clearly seem to be pointing towards a post-budget rally.
Sure. Anything in particular, Rohit, specific to the budget that will impact the markets?
Well, the budgets would really
negatively, because you seem to have a view that we are going on the bullish territory now.
Well, the negative could be if you try to raise taxes, and that would not be good for stocks in general. There was some news around such possibilities at the start of the month. Will you touch LTCG? Will you raise taxes somewhere? I think
just hold that thought. Markets opening. So we go to Karunya to get a market opening check.
All right, so this is the time when the markets open, and there you have it, just in line with the SGX Nifty. The Nifty 50 has opened very firmly in the green, up more than 0.5% as we speak, 100-point gain coming in, just an hour to go for the budget, or actually 2 hours to go for the budget. So right now we're in very, very firm fettle. Sensex is also up. The quantum of the hike is the same, up about 0.6%. Mid-cap indices also looking fairly comfortable. Advance decline ratio clearly in favor of the advances and in favor of the gainers. So yeah, Nifty and Sensex both looking very firm. Let's pull up the Bank Nifty as well. Okay, there you have it, 426 points up for Bank Nifty. Of course, banking stocks also will be in focus, not just because of the budget, but, in the anticipation of what the FOMC decision will be later today. So banking stocks is something that you should be watching out for. Even in the earlier show, we were talking about how several large cap lenders, even HDFC Bank, which has been a tad muted for all this time, looks very firm today in trade. Let's pull up some of these defense sector plays as well, because that is one core sector that could be in focus. I'll come to others as well, but let's start with some of the defense plays, the likes of BEL, HAL, BEML, Bharat Forge and L&T, how they're doing, if we could see some of these stocks. Okay, data patterns. Good set of numbers as well delivered. So it's having a really good week, and today also looking okay. There you have it. There's Deccan Cement, okay. BEL up 0.8%. So even looks like most of the breadth of the market is looking pretty comfortable, pretty firm right now. Nothing to worry about, at least as of now. We'll see some reaction perhaps when the budget speech starts, and depending on how it goes, we could see some knee-jerk reactions then. But right now, we're pretty much sticking to the global cues, sticking to domestic cues as well. Earnings have trickled in, so you have the likes of Britannia and Ashok Leyland to focus on. Then last evening, you had a bumper set of numbers being delivered by IHCL, Chola Mandalam, Max Financial. These were some mid-caps that could be in focus today as well. And let's also pull up some FMCG names, especially the rural-centric ones, the likes of Dabur, the likes of Imami, because if indeed the finance minister will be boosting rural spending, these are some stocks that you might want to keep on your radar. Okay. A positive open for Dabur as well. ITC looking a tad bit lackluster, but I mean, ITC at 350, I don't think we can really complain right now. And even the quantum of decline right now is very, very muted, so nothing to worry about there. HUL again looking very comfortable. It's trying to find its feet. Just close to that 0.5% mark higher. Fertilizer stocks, another pack that could be pretty much in the limelight today. Fertilizer, power, green energy and renewables. Now these are some broad sectors that we should be keeping on our watch list today. There's Chambal Fertilizers. Deepak is looking pretty firm. In fact, our technical analyst also earlier in the day said Deepak is looking very, very resilient and is poised for a good run up from current levels, and that's exactly what's happening right now. Deepak Nitrite, I think Mahalakshmi largely we're looking at a very comfortable market right now. No extreme reactions on either side, but yeah, clearly the market is tilting towards the gainers, is tilting towards a buying sort of a momentum and a buying mood right now. So back to you. As and when we get more updates, as and when the budget speech gets over, we'll get more market updates live here on Moneycontrol.
Fair enough. Thank you so much for that update, Karunya. It's things that business as usual, because usually on the budget day, before the budget, the market tends to be sort of, working in a very narrow range. It's just, waiting for the budget, and the real volatility begins as the budget speech begins and the key numbers are announced. We'll wait to see that and what happens for the rest of the day. But before that, Santosh, your take.
Well, clearly it's been a steady start for now, but at the same time, the chatter that one hears in the market at this point is that over the last couple of weeks, at least, a lot of people, a lot of traders have lost fair bit of money, which is why the overall mood of caution. So in that sense, it's still the market, I would say, at this point is fairly delicately poised. And you could, technical analysts are looking at some of the key support levels at this point in time. I just want to toss to Rohit here. Rohit, you'd been bearish for a while now, and now the change in sentiment. So if you were to look at key technical levels at this point, which are the levels that you would be looking at?
So I mentioned the 66% retracement of the entire up move that we got from the October low. So that level comes in at around 17,475. Ideally, it should hold on a closing basis. So we did see a slight intraday dip below that level, I think, in Friday's trade. But we didn't close there. So as long as we don't close below 17,475, I would think that the retracement is complete and, the risk reward is favorable.
Well, and in terms of on the higher side?
So on the upside, we start with, initial resistances close to say 18,200, 18,300. That's where it was not able to really cross that zone. In all the up moves it attempted in the early part of January. So getting past 18,200, 18,300, I think would be the first hurdle. Once we do that, we can become open to testing the highs again.
Yes. Fair enough. We're just waiting for Devina Mehra, a chairperson of First Global, to join us. Hi, Devina. Good morning.
Hi, Mahalakshmi. I've been waiting a long time.
I'm sorry about that. So, Devina, today is important not only because of the budget, but another event, the outcome of the FOMC meeting. What is your take? How are we poised?
As far as the Indian market is concerned, I don't think there's any point anticipating what the impact of the budget will be, which anyway is usually different on the day of the budget and the days that follow, because on the day of the budget, there's normally a knee-jerk reaction where people don't understand what's going on. And then only once they understand what's going on that the thing moves. And as far as the FOMC meeting is concerned, there is, the 25 basis point is what is built in. I'm sure Powell is going to again reiterate that they are not going to go easy till inflation comes down. Now, there are a lot of things where there has been signs of the markets, not the markets, but the economy slowing in the US, I'm talking about in terms of the PMI numbers, the industrial production numbers, inflation itself, housing. But the one thing which still remains very, very buoyant there, relatively speaking, is the labor market. So it depends on how much weight the Fed gives to that. So I don't expect any great surprise today. The real question will be that how long will they keep rates up? And that may or may not be so clear, because today I expect him to anyway reiterate that we'll do what is necessary, which has been the theme of his song. In the Indian market, I don't think it has a very direct impact. I don't think what the Fed does is going to very directly impact the market in the very short term. In India, we've been talking about the market not doing so well for a month or 2 months, but then you have to remember that last year, India was one of the best performing markets in the world. It was number 10 out of 42 countries. While it was down 4.7% in dollar terms, that is against global markets being down about 18.5%, S&P also being down 18 and odd percent. So relative to the global markets, it did very well. So this 1 month, 2 month kind of thing is not of great relevance, and I still expect India to continue outperforming.
Totally agree to that. But Devina, every time we went with some level of strength into the FOMC meeting, Jerome Powell managed to talk down the market, and the market usually reacted negatively. Do you think the markets are still so sensitive to what Powell says? How do you see that playing out in the stock prices?
Actually, often it happens that the markets react one way and then end the day another way. So that has happened. If you see the last FOMC meeting, right, that's often happened quite often, that the market immediately reacts one way and then ends up the other way. So now what you're seeing in the US is that a lot of the tech names are bouncing back from their from the great lows that they had hit of 40, 70, even 90% down. And last year, out of those 42 indices that I mentioned, NASDAQ was close to the bottom, I think 38 or 39 or something like that. So from there, even though we all know that theory that growth stocks get hit more when interest rates are high because their cash flows are further out, you're now seeing some bounce back in that. So that's for now, that appears to be the case. Let's see how long that lasts. We are still not very clear that whether that's a very long-term trend or not. But for now, you are seeing that the higher risk bucket, you can say, of the market is actually giving the returns because it was so beaten down.
Sure. So, Devina, you've made two important points. One is that you are bullish in India. Last year, we had a great year, so it is only natural that we are starting this year with some level of, we are, if I may say, caution, and we shouldn't read too much into the first month's, 2.5% loss. The second point you're making is that increasingly, India's growth is going to define our trajectory. Am I right?
Yeah, I mean, last year, if you remember, in the beginning, I had said that India will outperform. So,
Correct.
So I had said that at the beginning, or even the Diwali prior to that, because India had come out of a very long period of underperformance.
So you do expect this, this India-China, swap trade will quickly end?
I am not betting on whether FII money comes in or not, because that is not, as I've said plenty of times, or with you and with on other channels also, that I don't track it, because the data shows that there is really no correlation between the FII money coming in and the market, whichever direction the market goes. The biggest example of that is that when FII money came in first, which is 93, 94, 94 to 2003, 9 years, the market gave zero returns. The returns had come prior to that. And this was like fresh through one big source of money which didn't exist before. And there was no domestic mutual fund space to speak of. And yet it didn't move the market. So, there is no point trying to second guess what global asset allocators will do. Again, this is not what's going to drive the market. So you have to look at what's happening in the economy, in the companies, in earnings, as also, as I said, the history that you went through a very long period of underperformance, came out of it only in 2021, and that you're still away from the trend line, that Sensex compounding of 15-16% that we think of. You were far below that, so you're just doing some catch up.
Sure.
Hi Devina, Santosh here. Now I heard you mention recently that sentiment is always a contra indicator. So what do you make of the current sentiment in the market, and what does it seem to indicate?
On your discussion, you were talking about sentiment being at a low, or pessimism through various ratios that you are tracking on the derivative side. Yes, I mean, that is what academic studies also show, and not just in the US, across the world, Brazil, Portugal, wherever studies have been done, it shows that sentiment is a contraindicator. When sentiment is low, people are pessimistic, the next period returns are above average. And conversely, when people are very, very in a happy mood as far as markets are concerned, very buoyant, then the next period returns are below normal. And the biggest example of that, I mean, 2021, you had all these ETFs and funds being launched in India on the NASDAQ. And at that time, I used to tell people that just because NASDAQ has done brilliantly in the last 3 years, that is just recency bias. No theme lasts forever. This is not going to last forever. And then when NASDAQ crashed 40% thereafter, the same people wanted to head for the exit. So you are compounding a bad decision. So when coming back to your question, yes, sentiment is a contraindicator. So if there's pessimism, that's what data shows, that the likelihood is that the returns will be above average in the succeeding period, in the next period.
Recently, I have turned bullish on pharma, and you said that you've added some auto components also to your portfolio. What is the broad story on auto looking like at this point, Devina?
Auto components, and on autos, we would not be, auto components, we might be slightly overweight because the index has very little weight, but it's not a big story yet on autos because still a large part of the economy is hurting. Pharma was more that we were underweight and we had not liked it for a while, and this time our systems threw up a number of names. So we have added, and probably, I mean, relative to the index, we might be a little overweight, but it's not like an outsized position otherwise. And as far as autos are concerned, we don't have many auto companies, and I don't think we'll be heavily overweight, but consumption in India still is not broad-based. I mean, that is my concern, that still a large part of the economy is hurting. If you look at, for example, two-wheeler sales, they are still, I mean, while they are up from the lows, they're still pretty much down in the dumps, even if you look at a 10-year history. And if you look at higher-end SUVs and cars, those are selling. Again, entry-level cars, not so much. And if you look at Narega numbers, still more people are in need of work compared to 2018-19, again up from the COVID lows, but still, down the job requirement down from the COVID lows, but still very high. If you look at unemployment numbers, still not good, because whatever employment has been generated again shows up in agriculture, which shows that this is disguised unemployment, because people have to move away from agriculture for the economy to progress. 80 crore Indians still need free rations. So that shows you that the consumption story is still very much only at the higher end. At the organized sector, employees have done well, the creamy layer has done well, but the broad-based thing is not there. So that is one thing where I hope this budget does something, particularly on unemployment, because the rest of it will really be driven by whether people are working or not.
So, Devina, your take has always been, and I agree with you, that economy and stock markets are two different animals altogether. Do you expect anything in the budget, and I will exclude the short-term capital gains or any tinkering around capital gains, because that will definitely have a sentimental impact, and traders will react badly to any negative news there. Is there anything else in the budget that could actually impact or alter the complexion of any sector or pockets of stocks?
So capital gains, I doubt whether they're going to increase the rates or anything like that. That's very unlikely. They might do some rationalization, because right now, which is what the finance ministry officials had been talking through the year also, because it's a very complex structure with each asset having different holding period to qualify for long term. There is different rates, different indexation. So there might be some rationalization, but I doubt whether the government would want to spook the markets, because anyway, to collect capital gains tax, people have to make capital gains. So if you kill the golden goose, that also is not going to help the exchequer in any case. Other than that, I suppose it is more the policy announcements, maybe on infrastructure, maybe on something else, which can have a direct impact on certain sectors. I doubt whether the taxation side you'll see anything. The PLI scheme is already there. Unfortunately, just a digression on what we were talking about earlier, the PLI scheme is availed of mostly by the larger organized sector listed type of companies. But those companies don't generate a lot of employment. And not just now, for 20 years, I have seen that companies really boast about that I have set up this new plant and it hardly has any labor. So they try to minimize rather than maximize employment. So that's the other thing. So while PLI might be good for the manufacturing sector and so on, but it need not necessarily generate employment.
Sure. Devina, first of all, you are not allowed to say you need to make capital gains to pay taxes, because you are bullish. So the assumption is that we are going to make capital gains this year.
I said, like, if they change the capital gains tax, that's going to spook the market definitely, for sure. So from the government's point of view, it doesn't make sense to potentially reduce the amount of capital gains the people at large make.
Good logic. Okay. So Devina, you're saying that, sorry, I'm blanking out. You were talking about unemployment, creating more jobs. Clearly, and in fact, we were talking about all these, PLI schemes being availed by larger companies. The fact is that, all of that doesn't really translate into earnings growth for our companies. The dynamics there are very, very different. So I'll ask this question again. Any pocket that you see where there could be actual earnings impact or the complexion of stocks and sectors change based on budget announcements?
So as I said, infrastructure is one area where if there are a lot of announcements. So depending on which particular sectors, at a broader level, you will say cement if overall infrastructure a boost is there. But let us see, because there's also constraints on the fiscal side. So I don't know how much actual spending you'd be able to do. Last year also the government capex has begun to, this year basically, there has also been slowing down after a couple of years when it was the main driver of not just of overall GDP growth. So that has been slowing. So I don't know how that balance will be there between what you want to spend and managing the fiscal deficit.
Sure. One last question.
Yeah,
I will let her
one last question, Devina, from my side. What are your quick thoughts on the banking sector? That's been one space you've been bullish on for a while.
Oh, I mean, I've not been particularly bullish on in the sense that.
And for a person who is generally bearish on the financial.
Coming out of like being totally underweight and having negligible weight from 2020, which is when we started our PMS. And it's a sector that I generally don't like. So from there, by my standards, I have turned positive somewhere in the middle of the last calendar year. And because it again came out of a long period, 2020, it was the only sector in the negative. 2021, it went up only half as much as the market. So again, once that trend changed, and also fundamentally things changed, the NPA cycle was behind them. The interest rates going up means their margins go up, at least in the short term, because the loans get repriced immediately, deposits don't get repriced immediately, and the credit growth was good. So all those factors, we went to about market weight. With which price action, it has become overweight. I still remain positive. That's definitely a sector I still like, even though I am always, as I say, a cautious investor in banks, because you don't know where the negative surprises are hiding. But like this last week's whole impact after this whole Adani report was clearly overdone, which is what I said even at that time, that even banks which had no exposure to the group got hit and so on. So I remain positive on the banks. Not that we are hugely overweight or anything, but that's definitely a sector that for now looks like it should do decently well.
Thank you so much, Devina. We'll let you go. We have with us now Pankaj Tibrewal, Senior Executive Vice President from Kotak Mutual Fund. Pankaj, thank you so much for joining in this morning. Okay, let him join. Rohit, in terms of sectors and stocks, is there any pocket that you see that is looking well poised either for a sharp bullish turn or a bearish turn? You're bullish, so maybe that first.
So on the bullish side, I think I look at the two sectors which were the weakest during the last year. One is, of course, technology, and the second is the metals pack, which is related to commodities. I think both of them have meaningfully bottomed out. You're seeing commodity prices rise again in terms of copper prices or aluminum prices. And similarly, the IT stocks have retraced, I think, almost 50% of the gains that they made from the 2020 lows, which is a pretty steep cut that the IT index has seen. I think we are done there. We've started to move up, and I think it'll continue in line with what the Nasdaq has already started to do. So I do think IT stocks should continue their recovery from here.
Also, Rohit, just wanted to pick your thoughts on how some of the key banking stocks are looking on the charts, starting with HDFC Bank.
Well, tricky spot, but I think HDFC Bank is actually held out better than some of the others recently. It's of course a slow mover, but consistent. So it's not really fallen, I think, both in the sell-offs that we saw in October or in December. And in that sense has been mildly outperforming. So I think there's strength there. Even recently in the last 2 days selling, it didn't make a lower low. So that really speaks well in terms of HDFC's position.
There's always been this debate on the ICICI Bank versus HDFC Bank. So looking at the charts, what are the charts saying on that fight?
So I always look at relative strength. I mean, who's doing better in terms of near-term performance versus the other, and then we try to chase that strength. I think if I do that, then actually ICICI Bank is a winner in the last couple of months. It has been doing better, and so I would give ICICI Bank the heads up right now.
Tell me about the PSU pack, because that has been the strongest pack over the last 1 year. But then you see, the performance in the last week. There seems to be fresh worries emerging, and that was evident in the stock prices. In one day, you see 5-10% moves on the downside after a huge outperformance. Is that symbolic, or is that like an inflection point, or we should ignore it?
A lot of the moves I think we saw recently were because of selling that emanated from the Adani problem, and I think, if I'm not wrong, whatever we saw on Friday would be related to margin square ups, people who have made losses booking. So you saw some wild moves. I don't think we should take that as a trend. If we look at PSU stocks, they are still in the value bucket.
Right.
Even last year, when I was, before I turned bearish, I was bullish on the PSU stocks from that angle. I think sentiment at that time was that no, PSUs are a don't touch. Now at least that sentiment has changed, which is a huge beginning. And I think it's likely to stay. I think the trend in PSU stocks in general, because if the economy broadly performs, PSU stocks do tend to do a lot of business and do well. So I think we should have a positive view on them. They remain good dividend yield stocks as well. So in an environment where interest rates peak out or they do roll over, they provide that edge in terms of downside risk being capped because of the dividend yield.
So that's more a medium-term story, right?
Yes.
Immediately going into next 1 week, next 1 month, what do the charts tell you?
So the only thing I fear with PSU stocks is sometimes ahead of a budget, they do get bid up quite a bit, and there's always a case for a short-term pullback. I'm not sure that definitely happens, but because the market's been down, but we have seen PSU stocks get bid up ahead of budgets and then cool off after the budget. So from a pure 1 month point of view, I would be a little watchful on the structure, but remain constructive slightly medium to longer term.
Again, the point that Devina talked about, is the correlation between US stocks and India stocks really weakening now?
I think these things happen temporarily. I mean, we've seen deviations between Indian and US stocks for a couple of weeks, many times in the past, but eventually all the markets end up aligning. And the reason is very simple, that global liquidity is really flowing through all of these markets simultaneously.
Right.
And so I think the pattern will come back to alignment. It's just been a phase where we've seen this break between the two markets.
And Rohit, have you been tracking any of the Adani Group stocks?
I have, and I think, while nobody would really want to comment after something like this, but I do think that at least near term, I would sense the worst is over. And why I say that is, again, if we look at simple indicators like the RSI, for the Adani Group and a lot of the large caps in the Nifty, the RSI actually dropped below 30, which means simultaneously all stocks went oversold on Friday. For the Adani Group, very, very low. So they went to single digit readings. You had an 8 or a 6 kind of RSI. That usually doesn't hold for very, very long. So, short term, you start feeling that, yeah, this is the worst you've reached, and, things need to pick up from here. So, but what you can't bet on is the pace, because when sentiment is poor, it takes some time for things to improve. Even if we go a year back, when there was a SEBI report related to the group, the stocks remained punished for a couple of months and then picked up from there. So you need to give it that time, but it does look like most of the negatives are priced in for now.
Sure. In fact, that's one question. Is there any historic, evidence that, when you have these sharp gyrations, either on the upside or on the downside, and I can only think of index levels, for example, before the subprime in August, how the markets fell, or before the real .com crash happened, how the markets fared, 6-8 months before the real crash happened. Those become pivotal points, at least in, I'm not a technical analyst, but when you look at movements, when you see such large gyrations, it's indicative of something to come. Is that generally the case, or you have to look at each one case to case?
So what you would want to see when you're trying to, make a prediction, like are we in a situation like year 2000 or year 2008? The sell-off in equities needs to become very, very broad-based. So one of the reasons for me changing my view is essentially that during the sell-off that we saw in India last year, the fall did not become broad-based and deep. Of course, there are some stocks that did fall quite a bit, but there are others that did not. But when we see 2000 or 2008, it's once you peaked, every stock or every sector fell, and there was no place really to hide. So if that doesn't happen, then that this is not the same market. And that's, I think, that's what we are really looking at. Sentiment is looking the same because everybody's turning bearish, but the market behavior is not reflecting previous bear markets. That's
sure. Fair enough. So Pankaj Tibrewal, Senior Executive Vice President from Kotak Mutual Fund is here. Pankaj, good morning. Thank you for joining us this morning.
Good morning, Mahalakshmi. How are you?
Very good, very good. You seem to be in all smiles today. What is the positive news you're waiting for?
So the smile always has to be there because budget comes every year. And I think last couple of budgets have not been bad from market expectation perspective. And so we believe this year should be. And I think the government has walked a very good path and adjusted themselves according to the circumstances over the last 2 years. Last 2 years warranted increase on focus on growth because we were coming from COVID, and that has done well. The tax collection estimates were very conservative last year, even we said, and when we are ending this year, it clearly shows that government is overshooting on the budget estimates. And clearly our view this time also, which will be known in next 1 to 1.5 hours, that the finance minister will keep focus on growth and walk the tightrope on the fiscal prudence as well. So let's see how's the borrowing program, what is the fiscal deficit number the government is targeting for 23-24, and hopefully there's no tinkering on the capital gains tax. And if that's the case, it will be a good news for the markets. So no big event will be a good news for the markets in our view.
Sure. So Pankaj, as you rightly pointed out, last 2 years we have seen huge surprises, both on the GDP side, and tax buoyancy has been absolutely wonderful. And to government's credit, they have been very conservative in estimating tax revenues, and that has been a very pleasant surprise. Of course, crude also did not go the other way, which is what we were probably fearing last year. Now, going into this year, what will be a positive surprise from a macro standpoint? Last year, Nirmala Sitharaman, said that we will be on a path to fiscal consolidation. She'll bring down fiscal deficit to 4.5% in 3 years, which means that we should at least be expecting about 60-70 basis point cut to be seen as a credible path to fiscal consolidation. So 5.8, 5.9, what is your expectation on the deficit front?
So I think the number somewhere could be between 5.8 to 6.2. I'm keeping a spread of 40 basis points because there are too many moving parts in that. And I think that probably will be a good number where markets will not get disappointed at all. And our sense is that the tax collection and the structural reforms which have gone into the country over the last few years makes me believe that tax buoyancy will continue. And I always say that 100 crore bank account, 100 crore Aadhaar and 100 crore mobile connection is the deadliest cocktail India has got. And COVID has accelerated that. And in coming years, the way we have got surprised on GST over a period of time, I won't be wrong in saying that the country would be surprised on the income tax collections as well. So our sense is that tax buoyancy is continuing. The only thing we will look for in the budget is that the bottom of the pyramid is suffering, and that impact now we are started to see on consumption. Even in last quarter, when we did the field survey across distribution, the thing which came across for the last 2 months that consumption has slowed down materially, except 3 sectors, jewelry, hotels, airlines. Everywhere on the consumption side, we were seeing some kind of a softness. And I think bottom of the pyramid is now getting impacted badly. And I think there needs to be some boost to consumption, and the impact should be visible over the course of next 12 months. Last 2 years, we have focused a lot on infra, which has a higher multiplier effect, no doubt. But this time, along with the infrastructure and capital formation, we need to see the bottom of the pyramid on the consumption side. And I think that's where the support is needed.
Fair enough. Thank you so much, Pankaj. We'll come back with A. Bala will join us next. But before that, some pictures coming in from the Finance Ministry, Finance Minister's pictures. You can watch them and catch us on the other side with A. Bala, CEO of Birla Mutual Fund.
When I ask economists what are the big numbers we should watch out for, they invariably say fiscal deficit. Why are economists and investors so keen on the fiscal deficit coming down to 5.8% of GDP or even lower? Well,